So I am a self-proclaimed nerd. Um, Other people would probably call me that too. I like my numbers. I mentioned before, I'm this weird mix of tech and econ. I do have a couple of degrees in economics, as well as an MBA. So I'm very numbers focused. So the first thing that I do look at a particular deal is always the numbers, numbers, numbers. I will definitely look at the underwriting. I will push back on the underwriting, and I take a very conservative approach. And I'm a little bit more longer term than maybe a fix and flip that Paul had mentioned. I'm more on the 5 to 7 year hold horizon, if that makes a difference, because it helps soften those really huge roller coaster cyclicalities right now, especially what we're going through. So it's important to be able to kind of smooth out those highs and lows.
Got it. And who finds the deals for you? How do you guys find deals?
I have a wonderful network. Everyone says your network is your net worth, and that's totally true. I'm very team focused. So I work with different people all over the country. I have a team of deal sourcers and underwriters, and I definitely work very, very closely with them.
That's awesome. Very good.
Yeah. No, I'm very blessed with that, and ideally someone who loves Excel.
That's great. And how successful was your past performance? Like maybe one of your deals, I don't know, how successful would you say?
Sure. Well, I'll give one example. Like last year, I had a small JV and was able to do a cash out refi, buy out all the partners, and give them over about 22% annual rate of return. So they got a nice chunk of money at the end, especially when everyone was, all indicators were dropping. It was nice to write them a big check and say thank you for their investment. And in that case, it's very much win-win. I held on to the property, was able to create a legacy wealth for my daughters, and yet provide the investors a nice chunk of change for their trust in me.
Oh, that's awesome. That's great. I've always thought of that because I've never been in a situation. I have syndicated, and I am syndicating with other investors at this time.
Great.
And I've always thought, do you give the investors an opportunity to stay a part owner of that property? And do they have the opportunity to opt, to stay in, or do they just all opt out? To just cash out?
It really, again, depends on the legal structure of each deal, right? And what you forecasted. So it's harder with syndication because you're dealing with so many more partners that you're juggling with, and much easier with the JV.
Got it. Okay, fantastic. Paul, any questions?
Yeah, you're asking great questions. I think something that would be really interesting for folks to know a little bit about how Michelle goes about her business from maybe a top-down view is, Michelle, do you have a favorite marketplace that you like to look for deals? If you do, can you share a little bit about that? Is there any preference at all, or do you just like deals and just whatever deal looks good? Yeah, how do you go about that?
So it's kind of like a top down and a bottom up analysis. So the top down are the macroeconomics of each state, for instance, across the board. So I've developed my own kind of data analytics where I look at population growth, job growth in the last 12 months, crime rate, as I mentioned, landlord friendly or non-friendly states, median household income, and then I do a kind of a reverse housing affordability index, and all of these are raw data you can pull off of the U.S. Census, the census data, the US Bureau of Labor and Statistics, city data, things of that nature that's open source. And then, of course, the less so the landlord friendly or unfriendly rankings, but those are pretty, with relative ease, those are easy to determine. I have not yet developed a scorecard or analytics for the climate issue because we've all been faced and hit with the big sticker shock of insurance, right? So that is something that I'm currently brainstorming with a couple of other folks to see how we can create kind of a cross-country matrix about. But I try to compile all the macroeconomics, and certain certain states come up on top, others don't. Certain cities come up on top, others don't. And this is kind of something that you have to update on a frequent basis, or as much as the data has been updated. So that's one approach I do. And if that's the case, like Texas comes up pretty regularly across the indicators. There has been some flattening in terms of rent growth, some softening there. Insurance is a big issue when we're talking about the proximity of Texas toward, some of the larger cities that are closer to the Gulf. So insurance is almost tripled. It's crazy. So you have
crazy.
Yeah. And Florida, we're not even going to go there. That's like insane. But the traditional southern states that have attracted a lot of investors in the past are now being pummeled by much higher operating costs, such as insurance. So you have to fold that into your underwriting, which brings up the bottom-up approach, which is the numbers. I mentioned the numbers and your underwriting. I cannot stress how critical that element is to making your deal a success. I mean, if you had to choose, this wasn't part of your question, but if you had to choose one skill set that would help allow you that step up, it's underwriting.
So you brought up a lot there, and as you kind of described your process, you didn't seem to be very geographically bound. You mentioned earlier that you're from Northern California originally, in the San Francisco Bay Area. If you found a Bay Area deal, just say it was a 20 or 30 unit deal, to you, does that give more credence than, say, if you saw a deal in Reno or if you saw a deal in Austin? I mean, do you favor the California market, or do you have any markets that you favor, and if so, why?
Yeah, I mentioned Texas before. I'm still looking in Texas. I still look at opportunities in Florida, Arizona. I would love to find something that works in Utah and Arizona. I'm sorry, Utah and Colorado, for instance, and in California. I'm actively looking at deals there, but the numbers have to work. And for years, they weren't penciling out. And I'm starting to see some glimmers of hope, I should say, because it's critical that I protect the interest of my investors, and then also for my team, because they're working crazy hours and they're working hard and they deserve to be compensated. So I definitely want to make sure that it's a win-win for all.
So it sounds like you definitely like to really focus on a lot of what we call the metrics of the business. So you talk a lot about economics, income, the migration. Do you tend to ever look at where your investors particularly like to invest, or would you say that that's more of a secondary thing for you, and you prefer to find the good deal first, regardless of if it's something that an investor likes, because you know that, hey, well, I know that my investor likes, let's just say, Orlando, Florida, However, I found something in Dallas that, or maybe Denver, that no, I really like this more, and I think this makes more sense from the numbers and from a top-down perspective. And I would rather go for that as opposed to trying to find something in Florida just because an investor has that preference. Like, how do you kind of choose between those two if it's ever been presented to you before?
It has been presented, but for me, it's definitely find the great deal first.
Okay.
And if you find a great deal that the returns are solid, with very conservative underwriting, then the investors will follow.
Sure.
They're in it to make money, right? So if you can provide that, if you can provide like 20% or above returns, steady cash flow, and also a nice tax deduction due to the still present bonus cost segregation, bonus depreciation, then you're making them happy.
So let's delve into that a little bit more, because some of the people on the call may not understand like what some of the benefits are to the investors, and you just mentioned a couple as well. The first being the most obvious, which is what's the return on the investment to the investor, and you've been talking about 20% plus type of returns, those are phenomenal returns. I think maybe what some people would like to maybe try to understand a little bit more about that is, does that mean that investors get that as an interest rate? Do they get that as a preferred rate where they get maybe a piece of the deal itself with some interest? Do you mind sharing some of the details how you structure your deals?
Sure. Well, if it's let's just say a standard syndication.
Okay.
So you basically have something called like the GP carve out and the LP carve out. The LP limited partners stand for the investors, those people that are either accredited or non-accredited investors. I'm not quite sure if you want me to define that or not, but let's just say for the purpose of the example, it's just investors in general. And the investors are the limited partners, and they own, in a standard syndication deal, let's say 70% of the property. So they own 70% of the total pie, which is the property itself. And so of that, they get the cut of 70% of the profits on a yearly, quarterly, however you promise the investors to do your distribution. The standard is quarterly. So on a quarterly basis, you get a nice little notification from your bank saying that you receive X amount because you own this percent of the property. And then it doesn't necessarily have to be preferred. It can be. It depends on the deal. In preferred, if we choose to go preferred, then our standard is 7%. But then some people will some syndicators just say, okay, this is the average cash on cash. Let's just say 10%, 12% of annually of the deal, and you get 70% of that because that's 70% carve out. And at the end, when we exit and we make the investors whole, not only do you get your original investment back, let's say you invested 100, so you get 100 back. So in the meantime, you get your cash flow on a quarterly basis. You get a nice check at the end, let's say at the end of 5 years for your original investment, and then you get the equity upside of the appreciated value.